Welcome back to video 11 in the Masterclass series. Thank you again, Veena, for being here. We have been nailing through a lot of really good stuff about how to do your fund, how to do a fund, how to raise money for doing deals in real estate. So thank you again for this.
Thank you.
Guys, we're going to be covering a topic today, which is really, and this is kind of a selfish topic. I wanted to ask Veena about this for my own personal reasons, because this is a conversation I have quite often with my brothers who do business, with Pace, with other people like you that I have tremendous respect for. You know, you see a lot of different models about how people grow a portfolio or build wealth. And there's one train of thought, which is like, keep it all, you're the sole owner.
Yeah.
Or maybe there's a minority owner, but you're the majority owner in your deals. And you can own a whole lot fewer, right? So let's say you own 10 apartment buildings, and you have debt on them, but you're the sole owner, meaning you get all the equity, all the cash flow, it's all your deal, and you own 10, or you own 100, where maybe you have 10% or 20% or less. You're the minority owner. So again, it goes back to what you talked about. Do you want to have the whole grape, or do you want to have a slice of the watermelon? And I think we can kind of assume, well, a slice of watermelon is going to always be better than, the whole grape. But I don't know that that's just cut and dry. There might be an argument that says, no, own the whole thing, but fewer of it. You have less management, less moving parts maybe. I don't know. I'm conflicted, Veena. I'm so conflicted.
I'm not.
Okay.
Obviously.
Help me get clarity around this.
Here's why. When you have a whole grape, right? Like, it's nice. You don't have to share the grape with anybody. There's no other grape going around. It's just in your mouth, right? Like one full grape. What if the grape is bad? What if it's sour? What if it's rotten?
So all your eggs in one basket is where you're going with this.
A lot, right?
Yeah.
It's a lot to put all of your eggs in one basket. So when you have a watermelon, okay, if your slice isn't really good, that's okay, because there's all these other slices that exist. And it's unlikely that the whole watermelon is going to be spoiled. And if it is, there might be just a piece of it that's spoiled, and you have a really good piece.
Okay, so what you're saying then is if you own 100 apartment buildings and you're a minority owner, and let's say one's performing poorly, you got 99 that are doing good, it'll carry the weight kind of idea. Versus if you have, 10 and one goes bad, that's 10%. And that's versus 1% sort of idea.
Right.
So it really spreads out your risk.
It does. It allows you to diversify. Also, what's the thing we know about businesses and how they're valued?
The whole portfolio.
The whole portfolio is much more attractive for big money groups to come in and buy when you have a significant amount of assets. There's no multi-billion-dollar or trillion-dollar fund that is going to come and want to buy your $120 million deal. Now, if you have 100 of them, they're now interested in buying it. And they might buy it at a premium because now it's one transaction they're getting from a single owner, and they're getting to their scale very quickly.
Yeah, I think I would add to that too. What tends to happen is when you play small, meaning you're only going to do a few deals, you can't really leverage outside help, right?
No.
So you end up being like a mom and pop operator, and it's hard to grow out of that.
Which is great for us because we want to buy from people like that.
Yeah.
Right?
But you kind of own the job now.
Now, the caveat or the situation in which I do think it's better to have the grape instead of the watermelon, slice of watermelon, is if you can buy a deal with very little to no money out of pocket using, Pace's creative finance methods, like the Morby method, all these things, then yes, that makes sense all day long, because now you're owning the asset and you have very little risk because your capital's not tied up in the asset. But if your capital is tied up there, you have significantly more risk, right? Like, let's talk about your hotel.
Yeah.
You have $3 million into the deal of your own money, right? And that money...
Well, I have $1 million, so I have about $3.5 million.
But $1 million's your own cash.
Yeah.
Okay, so your $1 million, it's tied up in that one deal.
Yeah.
Is it producing you cash right now?
No, it's not open yet.
It's not open yet.
Yeah.
So that is like dead money to you.
Nothing coming in.
But if you had raised it from someone who has more aggressive capital, and it says, hey, I'm willing to wait, and you give them let's say you give them 70% of the deal.
Yeah.
Okay. And let's say you make $100,000 a year from that. Now you're getting $30,000 from that deal without actually having your own capital there. And you take the $1 million and you put it into my deal, where I'm going to give you 70% of my deal, right? So now your $1 million is making you money over here with my deal. It's tax efficient. And your money is not being put to work in your own deal, but your investor's money is. And now they're getting whatever the return is. Maybe it's lower than 70%. I don't know. But whatever it is, now their money's working and you're still getting $30,000 from that. So now you have just increased your overall value because that $1 million is working in multiple places.
Wow, that's profound.
Right.
Yeah, because you're right. My $1 million is sitting in that hotel, not earning anything. I could have raised capital, brought in other people's money, taken my $1 million, and now put it into work where it's actually earning, not just sitting right now.
Exactly. And you would still get paid your 30% or 50% or whatever it is on that deal where you have other people's money. So now your $1 million is already making you the 70% of someone else's deal, and you're making 30% on your own deal. So you still have 100%. It's just spread out. The risk is spread out.
So it's interesting. Off camera, we were talking about my hotel deal, and so again, I've got 2.5 million in short-term debt.
Yes.
Okay, no equity, short-term debt, 2.5. So I've got to get out of that capital in a minute here, right? And I've got
expensive debt.
It's expensive debt, and it's on a balloon,
right?
So it's a 3-year, and I'm a year in, right? So I gave myself a little time, but I got to get out of that debt at some point here soon, and I want to get my money back out of the deal. So I said, well, the SBA's talking to me about doing a loan on that. And then if I did an SBA loan, I'd pay off the investors, hopefully get some of my money back if it appraises high enough. And then I would own that hotel 100% me, right? Not a bad move. But what I suggested, and you guys agreed with it, was I could bring that deal into the fund, thinking long-term, big picture now.
Right.
And maybe that one asset could be a real jumpstart into my fund because now I'm bringing something to the table that very soon is going to be producing cash.
Right.
So, think bigger, right?
That's
I guess
exactly. I think not just bigger, but think long term.
Think longer term.
Yeah.
If that's going to help me do my fund faster, better, bring in more money.
Definitely do it.
Who cares if I could own it all myself? Give up equity.
Right.
Because I'm not thinking about one deal. I'm thinking about the next 5 deals.
Yeah, now you can do the next 5 deals because all of your cash, you have a finite amount of cash.
Yeah.
And when your cash is tapped, it's tapped. So if you want to get to scale eventually, if you're doing big enough deals, you're going to need other capital.
And you have to scale it. It's like, as soon as I feel like this, tell me if you think this is right. As soon as you go down the road of owning assets.
Yeah.
If you're going to own one single asset, you better own 100 of those assets, or you better own at scale.
Why
because
not?
Not only why not, but you will not be effective owning 10 single family rentals.
No,
you got to own
I've
1,000.
done that. I've done this before.
Or one 20 unit apartment building or 100 unit apartment building. You don't.
Much easier to manage.
Yeah. And if you're going to go through the effort of owning an asset and learning how to manage an asset, why would you not learn how to manage many assets?
Scale. That's exactly. It is not twice as hard to manage 20 doors than it is to manage 10 doors. It's not twice as hard to manage 2 hotels than it is to manage 1, because knowledge and experience is exponential. It's not linear growth.
And you're building infrastructure.
Exactly.
Yeah, so important if you ever want to scale past being a small player.
Absolutely.
In this business. Yeah.
If you want to. No, it's not for everybody.
Yeah.
Because it's hard work. I mean, I would be lying if I said, oh, it's easy and we just hang out all day and it just money. No, it takes work and it takes time. And it takes time to set up the correct infrastructure and correct process to get to a point where you can kind of take your foot off the gas a little bit. So it's hard. And there are many moments where I feel like quitting. I mean, every day I'm pretty much like have a thought of quitting at some point in the day.
Well, that's just normal, right?
That's just entrepreneurship.
It's interesting though. I talked to a really experienced hotelier.
You're so fancy, Jerry.
Right?
Look at you.
And I was telling him about my building, and he said, "How many units is it?" Or doors is it? And I said 22 plus, a restaurant and stuff. But he said, in the hotel business, under 100 doors is where money goes to die.
Yes.
Is what he said.
I agree.
And it hit me like a ton of bricks.
Yeah. And you were like, ouch, my 22 unit is hurting.
And so, and what he meant by that was, you don't start really leveraging resources till 100.
Scale, yep. You don't have scale.
Yeah, and I bet you 1,000's even more leverage.
Absolutely. Because 1, you have the experience of 1,000 doors. 2, you have better data points because now your N is 10x that. It's 1,000 in your N, right? Your population that you're looking at. So you can see trends and patterns emerge much better. There's a reason we pay tens of thousands of dollars to have access to licenses of national data. I want millions of data points, not just my assets.
Yeah. Awesome. Well, I think you've convinced me.
yes, my job here is done.
Yes, go big with this.
Go big or go bigger.
Give up equity, raise more money, do bigger deals is the only way you're really going to hit those big numbers, right?
Yeah.
And so I see that. That's so profound, Veena, and I wish I kind of really bought into that sooner, you know?
Remember what we said in that very first video?
Planting
the best
trees?
time to plant a tree was 20 years ago. Second best time?
Yeah.
Now, and now you're doing it. So
Yeah. Well, Veena, thank you so much, guys.
Thank you.
We got some tremendous resources for you. Be sure to check the link in the description below this video. Totally free. Compliments of Nick and you, you know, because Nick helped out with some of that. So awesome. So thank you again, Veena. And guys, be sure to watch the next video. If there isn't a next video, we are going to continue to add to this playlist.
To it. There'll be another video.
So stay
eventually.
tuned. We're going to keep doing more on this topic. If that's what you guys want, be sure to leave a comment and let us know. Yes, more videos. Yes, do some Zooms, do some lives, do some Q&As.
And what do you want to hear about? Like, what are their
tell us what you want to know.
Yeah.
I mean, for sure, there's going to be so many questions because how could there not be? Yeah, there should be. Yeah, so we're super excited about that. Thank you so much again for everything. You guys are the best, and we'll see you on the next video.
Thank you.